Have you ever wondered when the right time is to invest in stocks? The age-old advice is to buy low and sell high, but what does low really mean in the stock market? Is $10 a share low, or is it $100? These questions can be daunting for new investors, but fret not. We can shed some light on this matter by delving into a crucial concept known as the price-to-earnings (PE) ratio. The PE ratio is a powerful tool that helps us gauge whether a stock is overpriced or undervalued by comparing its stock price to some fundamental factors. In essence, it tells us how much we're willing to pay for a share of a company's earnings potential. Think of it like comparing prices per pound at a butcher shop. When shopping for meat, it's challenging to compare total prices because each cut varies in quantity. However, by examining the price per pound, we can easily determine which cut offers the best value. Similarly, multiples like the PE ratio enable us to compare a stock's price to the underlying financial strength it represents. While there are various types of multiples, the PE ratio, or price-to-earnings ratio, is one of the most popular and straightforward ones. Calculating it is relatively simple. You take the stock's current price and divide it by the company's earnings per share. Let's illustrate this concept with a practical example. Imagine Plain Bagel Company, a fictional company, has 1 million shares in circulation and each share is currently trading at $30. Last year, the company generated a net income of $2 million. In this scenario, Plain Bagel Company's PE ratio would be calculated as 15 times. Now that we have established a foundational understanding of the PE ratio, join us in Part 2 as we delve deeper into its significance and explore how it can empower investors to make well-informed decisions. Keep in mind that this is just the beginning of your journey to mastering stock valuation. Don't forget to show your support by hitting the like button and subscribing to our channel for more in-depth insights. Now that we've grasped the basics of the trailing PE ratio, let's delve into why this metric is so essential for investors. The trailing PE, also known as the trailing price-to-earnings ratio, is a vital tool that helps us determine how much an investor is willing to pay for each dollar of a company's historical profits. In our example with Plain Bagel Company, our PE ratio of 15 times illustrates that investors are willing to pay 15 times the company's earnings per share for a stake in its future. This ratio provides a clear perspective on the price investors are willing to pay for a stock. However, it's crucial to recognize that the trailing PE ratio has its limitations. One of its major drawbacks is that it relies on historical data, which is backward-looking. In contrast, financial markets often anticipate a company's future performance. For instance, if a company is expected to launch a groundbreaking product, enter new markets, or enhance its operations in the coming months, its stock price may rise accordingly. The trailing PE ratio doesn't account for such forward-looking factors. To address this limitation, many investors turn to the forward PE ratio. This metric, also known as the forward price-to-earnings ratio, assesses a stock's price in relation to the company's projected earnings for the next year. For instance, let's consider Plain Bagel Company's future prospects. Suppose analysts anticipate that the company will introduce an exciting new bagel product next year, leading to an expected earnings increase of $2.5 million. In this scenario, assuming all other factors remain constant, Plain Bagel Company's forward PE ratio would be calculated at 12 times. Understanding the difference between trailing and forward PE ratios empowers investors to make more informed decisions. Join us in Part 3, where we'll explore how these ratios can guide your investment strategies and help you identify potential opportunities in the stock market. In Part 2, we grasp the concept of forward-looking PE ratios and their significance in assessing stock value. But now, we must address the challenges associated with forward multiples. They depend on forecasts, which can sometimes miss the mark. However, these metrics remain valuable for estimating a stock's worth and the premium investors are willing to pay for a company's future profits. Plain Bagel Company serves as an illustrative example with its forward P/E of 12 times. But what does this number truly signify on its own? To answer that, we must engage in relative comparisons. Multiples are relative measures, and simply knowing the P/E ratio is insufficient. We need to evaluate it in context. Comparing the P/E ratio to Plain Bagel Company's historical P/E ratios offers insights into changing market perceptions. If the stock's earnings are projected to increase while its price falls, the P/E multiple contracts, indicating that investors may undervalue the firm's profitability compared to the past. Conversely, if earnings decrease while the stock price rises, the multiple expands, signaling that investors are paying more for diminished profits. We can also assess the P/E multiple concerning the stock's long-term average to gauge whether it's currently cheaper or pricier than usual. For instance, if the 10-year average P/E is 15 times, a P/E below this level may imply a temporary discount, potentially presenting a buying opportunity. This assumption relies on the belief that multiples tend to revert to their historical mean over time. While this isn't always the case, some investors seek extreme variations from the mean, betting on short-term volatility to subside and the multiple to return to normal. However, evaluating a stock based solely on its historical multiple isn't enough. To make informed decisions, you must also compare it to peers within the same industry. In our analogy, finding pork on sale for $6 a pound may seem like a deal, but it might still be overpriced if a nearby butcher offers it at the regular price of $2.50 a pound. Similarly, assessing a stock's value demands comparing it to industry peers. Let's take Plain Bagel Company as an example and compare it to Sesame Sands and Hangul Bagel, which have P/E ratios of 13 times and 7 times, respectively. In this context, Plain Bagel Company's 12 times multiple indicates that it's relatively more expensive than its bagel industry counterparts on average. In Part 4, we'll delve into the nuances of using multiples effectively in your investment strategy. Now, we stand at a crossroads. We've explored how the P/E ratio, when analyzed against historical trends and industry peers, can offer insights into stock valuation. But let's not be hasty in making investment decisions. Investing isn't a one-number game, it's a complex art. Remember, multiples have their limitations. Take the P/E ratio, for example. While it helps gauge relative value, it doesn't account for a company's growth potential. A stock with a seemingly high P/E ratio might actually be justified if the company is growing its earnings rapidly. High-growth sectors, like technology, often command higher multiples than slower-moving industries, such as utilities. Conversely, just because a stock's P/E ratio is below its peers or historical average doesn't automatically make it a great buy. The compression of multiples could be justified if the company's fundamentals have deteriorated. To illustrate, imagine you're shopping for steaks at a butcher shop. You see two steaks priced at $10 a pound and $3 a pound. Seeking a deal, you opt for the $3 cut. However, upon closer inspection, you realize it's an expired, lower quality piece, and you're not even sure if it's beef. What's the lesson here? Simply put, a lower price doesn't always equate to a good buy. A stock's lower P/E ratio might reflect a justified devaluation. Perhaps, in the case of Plain Bagel Company, the keto diet trend is expected to harm the bagel industry, or the company faces regulatory challenges that hinder its staple product, the plain bagel. Now, as we delve deeper into the world of stock valuation, we must acknowledge the complexities that arise when assessing a company's true worth. In Part 4, we saw that while multiples like the P/E ratio can provide valuable insights, they are far from infallible. Consider this: a low P/E ratio might tempt investors with the promise of a bargain. Yet, without a thorough understanding of a company's core operations and future potential, you risk falling into the dreaded value trap. This trap ensnares those who chase stocks solely based on low multiples, only to watch their investments plummet further due to deteriorating fundamentals. So, why discuss multiples at all if they can be both misleading and valuable? Multiples serve as a useful gauge of a stock's price level, but they should be used judiciously. The P/E multiple, for instance, relies on accounting earnings, which can be manipulated by management assumptions and non-cash items. Thus, while multiples aid decision-making, they must complement a comprehensive understanding of a company's operations and future outlook. A prudent approach involves first identifying companies with strong fundamentals and then using multiples to evaluate their valuation. Remember Warren Buffett's wisdom: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So, the next time you encounter a stock with a low multiple or a stake priced at a mere $3 a pound, take a moment to scrutinize the fundamentals, ensure the stake isn't expired, and verify that it's indeed stake. We appreciate your support. If you found this video enlightening, please hit the like button and consider subscribing. Don't forget to ring the bell icon to stay updated on our future videos. If you have feedback or topics you'd like us to explore, drop a comment below.